Hello and welcome deep value seekers to our analysis of Atlassian Corporation, ticker symbol TEAM. As of April 9, 2026, the current price stands at $58.96. Please remember this information is for informational purposes only and is not financial advice. Why this stock? The market is pricing Atlassian as a legacy software company, but we see it as an AI infrastructure play hiding behind a GAAP loss and a crashing share price. TEAM trades at approximately $59 today, down 75% plus from its 52-week high of $242, yet the business posted $5.76 billion in trailing revenue, growing approximately 20% YoY, with cloud revenue accelerating to 26% year-over-year growth and 3.5 M monthly AI active users surging 50% quarter-over-quarter as of Q1 FY26. The market is misreading Atlassian's GAAP losses, driven largely by SBC and one-time restructuring charges, as fundamental deterioration. Non-GAAP operating margin held steady at 23%, and the company generated over $1.4 billion in free cash flow in FY25, a cash machine masked by accounting noise. Atlassian announced end-of-life for data center products, Atlassian Ascend, forcing 300,000-plus enterprise customers onto cloud. This migration wave is a multi-year revenue tailwind that Wall Street is treating as a near-term headwind. 42 analysts have a median price target of $152.50, implying approximately 160% plus upside from current levels. Atlassian builds team collaboration and productivity software, primarily Jira, Confluence, and Jira Service Management, that serves as the operational backbone for software development IT and business teams at enterprises worldwide. Software development teams, IT, ITSM teams, and business/project management teams at companies ranging from SMBs to large enterprises, 300,000 plus paying customers globally, with accelerating enterprise penetration, 53,017 customers with greater than $10,000. Cloud arranged by as of Q1 FY26, plus 13% YoY. Cloud subscriptions, primary and fastest growing, data center term licenses being phased out via Atlassian Ascend migration, and marketplace/other, third-party app ecosystem and Premier support. Key scale metrics include over 300,000 customers, a total addressable market of over $50 billion across team collaboration, ITSM, and DevOps, serving over 200 countries. Atlassian is headquartered in Sydney, Australia, and was founded in 2002. Looking at revenue streams, cloud deployment services is the core driver, representing 66% of revenue, with 27.73% year-over-year growth. Data center deployment is still strong, but marketplace and services deployment is slowing down. Switching cost 5 out of 5. Atlassian tools, particularly Jira and Confluence, become deeply embedded in engineering and organizational workflows. Thousands of custom workflows, integrations, historical tickets, wikis, and cross-tool automations are built on top of Atlassian infrastructure over years. Migrating away requires not only replacing software, but retraining teams, rebuilding processes, and migrating years of institutional knowledge. The Teamwork Graph, Atlassian's proprietary data layer linking people, projects, and knowledge, compounds this lock-in. The more a company uses Atlassian, the more valuable the graph becomes, and the more catastrophically painful it is to leave. Network effects score 3 out of 5. Within enterprises, Atlassian benefits from strong intra-company network effects. As more teams, dev, IT, HR, legal, marketing, adopt Jira and Confluence, the value of shared visibility, cross-functional tickets, and connected knowledge compounds. The marketplace ecosystem, 5,000 plus third-party apps, creates a platform flywheel. More customers attract more ISV developers, which drives more integrations, which attracts more customers. Rovo AI now layers on a knowledge graph network effect. The more employees use Rovo, the richer the enterprise knowledge base it can access and synthesize. The brand scores 4 out of 5, strong within developer and IT communities. Jira is the de facto standard for agile project management. It's often the first tool a new dev hire learns and expects to see. This brand familiarity creates a bottom-up, PLG, product-led growth dynamic that drastically reduces enterprise sales friction. Atlassian's developer-first reputation, earned over 2 decades, is extraordinarily difficult to replicate quickly, even for well-funded competitors like Linear, Notion, or Monday.com. Cost Advantage receives a rating of 3 out of 5. Atlassian's low-touch PLG sales model, historically minimal direct sales force, allows it to serve hundreds of thousands of customers with a leaner go-to-market cost structure than traditional enterprise software companies. However, this advantage is narrowing, as the company invests more heavily in enterprise sales to compete for larger accounts. The recently announced approximately 10% workforce reduction, focused on redeployment to AI and enterprise sales, is an effort to recapture operating leverage as the business scales. Regulation and IP 3 out of 5. Atlassian holds significant IP in its product suite, particularly in the Teamwork Graph, a proprietary knowledge and relationship data model built over 20-plus years of usage data. The company also benefits from enterprise data governance and compliance certifications, Society 2, ISO 27001, FedRAMP, which act as de facto regulatory moats for customers in financial services, healthcare, and government. The DX acquisition and Rovo AI capabilities further build proprietary IP around engineering intelligence and AI-augmented work. The acquisition of the Regulations 3 out of 5. Browser company, Dia/Arc, adds IP and AI-native productivity tooling for knowledge workers. For our DCF, the FCF per share over the trailing 12 months is $11.75. We assume a conservative growth rate of 12.5% per annum. The analyst consensus forecast for EPS is 21.77% annually. We anticipate a yearly reduction in shares outstanding of 1.13%. Our discount rate is set at 15%. This represents the required rate of return for the investment. We are applying a 30% margin of safety to the fair value. The exit PFCF multiple is an 18, representing a long-run assumption. The projection period for our DCF model is 10 years, which serves as our DCF horizon. The DCF output suggests a fair value of $108.93, indicating an 84.75% upside. Applying a 30% margin of safety gives us a MOS price of $76.25, so at the current price, we get a lovely 45.87% margin of safety. The reverse DCF analysis shows that the current price implies a growth rate of 10.25% per year over the next 10 years, using a 15% discount rate. Our final verdict is that Atlassian is deeply undervalued, with an 84.75% upside to its fair value of $108.93, compared to the current price of $58.96. Atlassian is a deeply moaty enterprise software platform. We believe the market is misreading GAAP losses and data center transition noise, offering a re-rating catalyst. Thank you for watching. Remember, this video is for informational and entertainment purposes only, and not financial advice. Always conduct your own due diligence.